This is the legendary trader Nicholas Darvas, and this is the Darvas Box, his trading strategy. Now, you may be wondering,
who the hell is Nicolas Darvas?
Well, Nicholas Darvis was a successful stock trader and investor who became famous for his trading success in the early 1950s. He was born in Hungary in 1920 and moved to Turkey in 1943. Darvis initially worked as a professional dancer, touring the world with his sister as part of the Darvis and Julia dance team. In the early 1950s, Darvis began trading stocks based on his own unique approach. He developed a method of technical analysis that involved identifying stocks with strong price momentum and trading them based on support and resistance.
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 Yeah, that's support and resistance. He used a strategy of buying stocks that were breaking out of their 52-week highs and setting tight stop losses in order to minimize risk. Now, after becoming super successful and making millions of dollars in the stock market, he chronicled his experiences and strategies in his book titled How I Made $2 Million in the Stock Market. Now, you may be thinking, how did he do it? How does the Darvas Box strategy work? Well, the original Darvas Box strategy is a swing trading strategy, so this is the daily chart of Amazon. But don't worry, you're not going to be tied to the daily time frame because this strategy works in almost all markets and in all time frames. Now, how do you draw a Darvas box? The first thing you need to look for is a new 52-week high. A 52-week high is the highest price point reached by the market in the last 52 weeks. In this particular example, this is the 52-week high. After the high is created, price needs to stay below that high and to not break and close above it for the next 3 candles at least. After 3 candles have passed without breaking and closing above it, that becomes the high of the box. Now, for the law of the box, you just need to identify a swing low that was created after the high was established. But what is a swing low? Well, a swing low is basically the lowest price point that hasn't been broken by at least 3 preceding candles. In this particular example, this is the swing low. We're going to draw a horizontal line here to establish the law of the box. There you go. This is the Darvas box. Now, to take a trade based off of this, you just wait for the price to break and close above the box like it did on this candle. And then you're going to confirm that there is sufficient volume in the market to push the price upwards. And then you enter the trade. Now, this is one of the trades that Nicholas Darvas took in the early 1950s. As you can see here, this is the Darvas box, this is the high of the box, and this is the low of the box. Once the price broke and closed above the box, Darvas entered a trade right here. His stop loss, which was inside the box, got triggered, and sadly, he lost the trade. He then re-entered the trade at point B and took additional positions at points E and F. He exited all the positions at point G, making a total profit of over 100%, which is really outstanding. Now, as mentioned earlier, the modern version of this strategy that I'm going to show you can be used in almost all markets and in all time frames. I'm going to show you how to set it up on TradingView soon after introducing the sponsor of this video, hankotrade. If you're looking for a broker with some of the lowest commissions and spreads in the market, then check out hankotrade. I use them on a daily basis. As you can see here, this is my trading history. I mainly scalp gold, and up here you can see that it's a live account. For those of you that love high leverage, hankotrade offers up to 500x leverage, which basically means that my $1,000 deposit could have the buying power of $500,000, which is really insane. And if that's not enough, they're also going to give you a 100% bonus for all your deposits up to $25,000. So if you deposit, say, $500, they're going to give you a bonus of $500, so you'll have $1,000 to trade with. To get access to the bonus, as well as all the other perks, sign up to hankotrade using the link in the description of this video. Now, back to the video. This is TradingView.com, and this is the 1-hour time frame of odd NZD. Now, the first indicator that we're going to add is one that's going to be used to draw the Darvas boxes for us. You didn't think we're going to do all that work manually, did you? Click here, then type in Darvas Box Theory. Select this one by John. Then type in Simple to EMA Cloud. and select this one by Olignator. Lastly, type in Water Attar Explosion, this one by Cheyenne KM. Double-click on the Darvas Box indicator. On the Inputs tab, change the lookback range for all these timeframes to 5. Then here, you're going to change the border style to solid. You're going to increase the width a little bit and reduce the background color's opacity to 0%. And you're going to do the same here. After that, click OK. Then you're going to double-click on the EMA Cloud indicator. On the Inputs tab, change Slow EMA to 200 and the Fast EMA to 60. And then click OK. Then you're going to double-click on the Water Attar Explosion. On the Style tab, change the explosion line's color to white and increase the opacity to 100%. Then you're going to change the dead zone's color to yellow and increase its opacity to 100%. Then here you're going to change the display style to lines. This green line of the 2 EMA Cloud indicator is a 60-period EMA. It reacts faster to price changes and is going to be used to identify short-term trends in the market. This red line is a 200-period EMA that reacts slower to price changes, so it's going to be used to identify long-term trends. Trading only when the price is above or below both of these lines ensures that not only are we trading in the direction of the long-term trend, but also in the direction of the short-term trend. The Water Attar indicator is a volume indicator, and we're going to be using it to confirm that there is enough volume in the market to push the price in the direction of our trade. The Darvas Box indicator is going to give us the entry signals. When it prints a green Darvas box like this one, this is a signal to buy. And when it prints a red Darvas box like this one, this is a signal to sell. Now, how do we trade using this strategy? Well, here are the conditions. To take a long trade, first, the green line of the 2 EMA Cloud should be above the red line and the price should be trading above it. This indicates a strong bullish trend. Second, the Darvas Box indicator should print a green Darvas box and the price must break and close above the box. So like here, you can see that this is a complete Darvas box, and on this candle, price broke and closed above the box. Lastly, at the time the price breaks and closes above the box, the histogram of the Water Attar explosion should be colored dark or bright green to indicate the presence of bullish momentum. It should also be above this white line, as well as above this yellow line. All our entry conditions are met on this candle, so we're gonna enter a long trade. The stop loss is gonna go somewhere in the middle of the box. And for the take profit, we're gonna set it at 2 times the risk. We let the trade run and take profit. For short trades, we're just gonna reverse all the conditions. So first, the red line of the 2 EMA Cloud should be above the green line and the price should be trading below it. This indicates a strong bearish trend. Second, the Darvas Box indicator should print a red Darvas box and the price must break and close below the box. So like here, you can see that this is a complete Darvas box, and on this candle, price broke and closed below the box. Lastly, at the time the price breaks and closes below the box, the histogram of the Water Attar explosion should be colored red or orange to indicate the presence of bearish momentum. It should also be above this white line, as well as above this yellow line. All the entry conditions are met on this candle, so we're gonna enter a short trade. The stop loss is gonna go somewhere in the middle of the Darvas box, and for the take profit, we're gonna set it at 2 times the risk. We let this trade run, and it hits take profit. Nicholas Darvis recognized that this trading strategy would not work well during ranging markets. So to address this, he focused on trading stocks with increasing volume and rising earnings, which were more likely to have strong bullish trends. He believed that trading with the trend was key to his success. What do you guys think of this strategy? Let us know in the comment section below. That's been it for this video. Hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching, and I'll see you guys next time.